What are deferred tax assets and deferred tax liabilities, and why do they exist? In order to understand deferred tax liabilities or assets, you have to understand that there's two different worlds when you're thinking about income. There's GAAP and what you do for financial reporting. That's what you traditionally will see in your books when you're pulling information. And then there's taxable income that has a little bit of different rules. This adheres to one set of rules, this adheres to another set of rules. Why? Because the government tries to stimulate different types of activity based off the tax that you spend and when. As an example, there are two different depreciation methods in each of this world. On the GAAP side, we'll just use something traditional called straight line depreciation. Each year you take an expense based off of what you spent on an asset, how long you think it's going to last, and what you think the recovery value is at the end to determine this is the cost that is expensed each year. On the tax side, you have something a little bit more complicated called MACRS, M-A-C-R-S. It stands for Modified Accelerated Cost Recovery System. On this side, what they allow you to do is take more depreciation up front than compared to your books because the worlds are slightly different. Now, if you were to look at your financial statements on the GAAP side, you might see that your tax liability should be higher compared to what is actually reported in taxes on this side. And as a result, you are going to have a mismatch. They will eventually even out, but you're going to have a temporary mismatch that is going to lead to a deferred tax asset or a deferred tax liability. The way to think of it is the classic example of depreciation. If on this side, the GAAP income side, I'm going to be taking less depreciation compared to MACRS, where I will be taking more, that will mean that my taxable income is actually lower than compared to what I'm reporting in GAAP. As a result, I will most likely owe more tax compared to what I see over here in the future. And when you owe something in the future, you have a liability. That difference arising from the two different places, GAAP on this side and taxable income on this side, as a result of this depreciation difference, straight line on this side and MACRS on this side, arises a tax liability, a deferred tax liability. It means that I am going to most likely owe more tax in the future compared to what I have paid today. The deferred tax asset is the opposite. I paid more today compared to what I normally would need to pay if I were looking only at the GAAP side compared to the taxable income side. A little confusing, yes, but understand that if I owe more future tax liability. If I will owe less future tax, it's a deferred tax asset, and they arise from the different classifications of different treatments of accounting based off taxable income and GAAP income.